Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, last week we kicked off the show with a trade that you had actually done on the 31st of December, so sneaking in there when most other people were on holiday, and it was a trade going short against the rand, long of the dollar, I suppose. How's that working out? Because we were laughing last week saying, you know, if you see the rand making front page headlines, that's probably when you want to kind of cut your position. And I know that Carte Blanche is preparing some sort of special documentary this weekend, and wondering maybe if that indicates the end of weakness.
Yeah, I don't think so. I'm still waiting for that front page headline to be on the, splashed across the front pages of the major newspapers. And I suspect that'll eventually only happen when the rand goes out through 11 rand to the dollar. So I'm still in this trade. It's working out quite well for us. If we have a look at the chart on the screen at the moment, basically what that shows you is that over the last 2 years there's been a very steady weakening trend in the rand. And what I was looking for at the time was a break through this overhead area at 10 rand 50. Now, basically at the end of last year, as you said, on the 31st of December, while everyone was planning their New Year's party, I snuck in and managed to short the rand at 10 rand 47. In anticipation that it would break through that 10.50 area. And it has done exactly that. So I shorted at 10 rand 47. I've used currency futures to do this.
Yeah.
So the currency futures price that I paid was 10 rand 60. My stop loss off of the spot price is 10 rand 25. And I'm looking for a move to about 11 rand and maybe beyond 11 rand to the dollar here. I know it's been bumbling along between about 10.82 and 10 rand 90 over the last week or so. My sense is that this is probably just a consolidation before another leg weaker. So I'm happy to stay short the rand at the moment. Technically it still looks vulnerable, and fundamentally I just can't see any really strong reason why the rand should go stronger in the near term.
So you don't see it retracing to 10.50 and perhaps even dropping back below that level?
Look, it certainly could.
Would you say are higher and it going the opposite direction?
I think the odds of it going weaker definitely are. I mean, the trend is your friend, and in this case the trend definitely is weaker, and the momentum seems to be behind the rand going weaker. Certainly it could come back to 10.50 and retest that breakout and then go weaker again. So I'm not going to say that that's not possible, because it is possible. But if I just look at the momentum that's with the currency now and look at the fundamentals that are not great, I still think there's a likelihood that we go to 11 first and then maybe we retrace at some point. Anyway, I'll see. I mean, I also obviously need to try and protect what profits we have in this trade. So I might look to institute some sort of a trailing stop loss just to in case, because I wouldn't want to see all of these profits disappear.
Because it is in the money.
Yeah, it is in the money. It's about 8,500 rand in the money. So it's looking good for us at the moment.
Yeah. Okay, Garth. So I suppose. Okay, so that's the one trade you've got on the go. What about the top 40 index? That's something that you want to highlight today, and tell us why.
Yes, well, I want to look at this because we're doing a trade, we're doing an options trade on the top 40, which we'll get into the nuts and bolts of that just now. But I want to just sketch the bigger picture in terms of what I'm seeing here. Now, this is a chart of the top 40 that goes back through right to the beginning of this bull market that started in early 2009. And you can see the market's been steadily climbing through the last nearly 5 years now. You can see that trend line that I've introduced on that chart ties in with all the significant low points on that chart very, very nicely. This light blue line that is on the chart here, that's the 200-day moving average. And what you'll notice is that the market does tend to retrace back to that 200-day moving average every now and again. Now, at the moment, we're sitting quite far above the 200-day moving average and quite far above this primary uptrend line as well. And my suspicion is that at some point we will see a retracement back to both of those, back to the 200-day moving average and back to the long-term uptrend. And I think, for me, I get the suspicion that this year in the market is going to be very much like 2011 was. And if you have a look, 2011 is the area that I've highlighted in the block over there. And you can see it was a very tricky year to try and trade. The market went sideways. It was choppy. There was no particular trend to it. And I remember, having a difficult year myself trading that year, and particularly for this show. It wasn't one of our best years by any means.
I certainly remember our donation to charity wasn't quite as big as we would have wanted it to be.
Absolutely, it wasn't, no. And I think that we probably are in for a similar sort of scenario this year, if I have to apply my mind to it. And the reason I say that is that our market multiple is very high at the moment. We're sitting on a PE multiple of somewhere around about 19 times for the JSE versus a long-term average of 14.5. So on that metric, we're about 25% overvalued. Obviously, the valuations are very fractured between different sectors and whatnot. I mean, you can't throw a blanket over the whole market and say that the whole market is expensive, because some sectors are very expensive and some sectors are not that expensive. But anyway, be that as it may, I still think that given that extended valuation, given the fact that our economic growth is very anemic in this country at the moment, given the fact that we've got quantitative easing now being tapered off in the US and that emerging markets are likely to suffer for that, with that withdrawal of liquidity out of the financial markets, I find it very difficult to believe that our market's going to go aggressively higher this year. And I think the likelihood is far more that we will see some sort of sideways, choppy action with the occasional bout of weakness, like what we saw in 2011. And that's pretty much my base case scenario. So, given that, our long-term uptrend currently comes in at 37,500 on the top 40, which is around about 12% below the current level that we're currently trading at. And I suspect that at some point, whether it's in the next few months or whether it's only in the next 6 to 9 months, I don't know, but at some point I reckon we're going to go down and test that long-term uptrend and that 200-day moving average.
Which would be, I suppose, healthy for this market, actually. And I certainly know a lot of people are hoping it's going to do that, because they feel at that point they would probably get enticed back in.
Yeah, I think it would be healthy. And markets don't go up in a straight line forever. And when we're as stretched as we are now, I think it's only reasonable to expect that we are due some sort of consolidation and some sort of potential pullback. But again, as I say, when that will happen, I don't actually know. And that's why the trade that I've instituted this week, it's an options trade. It kind of gives me 6 months worth of time for this to happen.
Okay, you talk about time, and that was the longer term graph going back to 2009. This is a bit of a shorter term graph.
Yes.
And I suppose that maybe if you could flesh that out in detail, showing what you expect there.
Yeah, well, this is now the top 40 showing trade since the beginning of 2013, really. You can see that primary uptrend that I mentioned going all the way back to 2009. There it is. That's the 200-day moving average, that light blue line. Now, the thing is, as I said, I would expect at some point we're going to pull back to that long-term moving average and to that long-term trend line. And for this week's trade, I want to try and create something that is going to enable me to participate in weakness down towards that area, but that I can do it at a very low cost and with very low risk. And I'm not a big fan of going outward, naked short on the market, because you can always have a short squeeze that pushes the market up and then you get hurt. So for that reason, I'm not a huge fan of trading on the short side generally. And when it comes to trying to put bearish structures in like this, I far prefer doing it via option structures, which we've done quite a few times for this show, and we've done it successfully quite a few times as well. And I'm looking at doing another one of these now today, and we're trading this out to June of this year.
Okay, I mean, it sounds like the ideal trade, a trade that sort of hedges you on all sides at low cost. This sounds like, the nirvana of trades.
Yeah, it does. And I mean, I'm very chuffed with what I've managed to structure here.
Okay, so talk us through it.
Let's have a look. Now, this option structure that I've done is what we call a put spread structure.
Okay.
Now, this chart that I've got on the screen here shows the levels of the index, the levels of the top 40 along the bottom over there. Now, given that we're currently trading somewhere around 42,500, which is pretty much to the right extreme of this chart, on the left-hand axis here, you've got your profit and loss curve. Above the line is profit, below the line is your loss. Now, a put spread is a structure where I make use of two put options overlaid against each other in the form of a spread. So let's break that down into its constituent components. The first trade that I've done here is a 40,000 strike put. I've bought two of these. Now, by being long of two put options with a 40,000 strike, what it means is that I effectively have the right to sell or to go short at 40,000 if the market should go below that level. Okay. Because I've bought those options, I have to pay a premium for that. It's kind of like an insurance policy. You pay a premium for it. I've paid 10,699 Rand for each of these put options. Because I've done two of them, it effectively means that it's cost me 21,000 Rand in order to put that trade on. 21,398 Rand is actually the total cost. Now, the thing is, that option structure works from 40,000 and down, and it will continue to make money all the way down to zero in the market. But let's be honest with ourselves, the market is not going to zero. So why buy something that gives me participation all the way down to zero? Can I not sell away some of that downside in order to recoup some of this cost and in order to offset my costs? So what I've done in order to effect that is I have now sold 4 put options with a strike of 37,500.
Okay.
And for that, I receive 5,136 Rand for each of those put options. And because I've done 4 of them, it means that I receive 20,544 Rand. Now, what you can see here effectively is that the premium that I receive on the short put option it offsets the premium that I pay on the long put option to a large extent.
Can I ask a very stupid question, potentially, probably, which is why are I suppose the fee or the cost of the June Aussie puts so much less than the 37,500 level cost less than 40,000?
The reason being because those are far out the money.
Okay.
And the likelihood of those put options ever being exercised is far less.
Right.
So in other words, the risk that you're insuring, I suppose you could say, is far less of a risk, and therefore the cost is less.
Okay. So you talk about the low cost of this, and having set those against each other, ultimately, what do you actually end up paying? Not very much.
No, not very much at all. So if I take the net payoff of those 2 structures together, I introduce that blue line onto the chart there, and that is now the net payoff of this put spread option structure. Now, if I tidy this graph up a little bit, it looks like that. The total cost that I've paid for this structure now, offsetting those 2 premiums, is only 854 Rand. That's all the premium that I'm going to be paying for this structure. And if you have a look here, I mean, the green area, that big green triangle, is our area of profitability. Below 40,000, all the way down to 35,000, that's where we make money. We make the most money at 37,500, and that's where we will make a profit of just over 47,000 Rand. So if you look at that in terms of a risk to reward ratio, it's a 1 to 55 risk reward ratio, which is phenomenal. I think that's the best risk reward ratio we've ever managed to achieve on any trade on this show. But that's of course assuming that it works. Now the thing is to remember that if the market remains strong, given that we're currently trading up here somewhere north of 42,000, so obviously the market would need to fall quite a lot in order to make this structure viable and effective. But if it doesn't, if the market remains strong, all I lose is the 854 Rand that I've paid away. And that's it. And I'm happy to lose that, quite honestly. It's 0.3% of the capital that we've got at our disposal. And if you look at that what does it mean in terms of participation on the downside? Well, if the market falls anywhere below, say, 6%, all the way down to 17% weaker, this is where our structure makes money. The sweet spot is if we have a 10% correction in the market.
And if you overlay that against what, if you put that against a chart of the top 40.
Yes, well, here it is again. So this is the chart we showed earlier. And remember I said that I wanted to try and create some sort of protection or participation in this area at low cost and at low risk. Now what we've done, if we look at it, is I now take that profit and loss curve and I sort of turn it on its side. And that illustrates it very clearly there, overlaid on the graph. You can see here, anything below 40,000, we start making money. We make our most money at 37,500, and then only below 35,000, then the structure would start to lose money. But there are ways that I can hedge that risk out as well if we get there. But the bottom line, the point to this is really that the meat of the trade, the rump of it, and the sweet spot is at around about that 37,500 area where the long-term uptrend and the 200-day moving average would come in.
Garth, we're running out of time, so where and how would you do this trade very quickly and then show us what the portfolio looks like? All
right, this trade I've effected through Safex, so you need to have a futures broker and your futures broker should be able to contact a market maker for you to effect this trade.
Okay.
All right. And then, the portfolio, as you said, this is how it looks at the moment. We've got our currency futures trade on where we're up 8,700 Rand. Our put spread structure, as I said, we've paid away a premium of 854 Rand. So net, we're sitting up 3.5% for the year to date, just shy of 258,000 Rand.
Okay, and then 2 seconds left for your
All right,
courses.
I've got high probability trading courses coming up in Joburg, Cape Town, Durban. There's also an Understanding CFDs course, and then face-to-face session on the 30th of January. Anybody that wants to find out info on any of these, you can go to my website, traderscorner.co.za, or you can email me as well, and I'll send you the information.
Okay, and if you want to revisit this trade, you can do so on the web.
Yeah.
Garth, thanks very much. We'll leave it there. That is Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.